Hello and welcome back to the channel. If this is your first time with us, my name is Alex. I am your Hawaiian guy here in Canada, loving life. Here in this channel, we like to talk about all things regarding investing. I give you my top stock picks for the month. I also go into background information, why I think those particular stocks are poised to do well. I answer any questions that you send me to the comment section. But above all, I try to make understanding the stock market a little bit easier for individuals new to the market, and we try to have a little bit of fun. If that sounds like something you're interested in, do me a favor, hit the subscribe button, hit that like button, become part of my Hawaiian Canadian family. All right, guys, let's get into it. All right, let's get into today's video. And I want to talk about a topic that's probably on a lot of new investors' mind. Is this the time right now during the correction in the market to pull all your money out and wait for the correction to end? The first part of that, yes, there's definitely a correction going on in the market right now. Is this something unusual that doesn't normally happen? No, corrections in the market happen quite often. I would say about every decade or so. And no, I don't think you should pull all of your money out and try to wait for the correction to end. And I'll explain why. I think when we think of the stock market, maybe they're using the term buying and selling stocks. Maybe that terminology should be maybe tweaked a little bit, because what you're actually doing is you're buying into a company. You're actually becoming a part owner in a company. And normally when you buy a company, you don't buy that company hoping that you make a lot of money in the next couple hours and just sell it. I mean, if you're a day trader, maybe that's something a little bit different. But for the most individuals, when you buy a company, you buy it for the long haul and you wait for some equity to gain in that company before you actually sell it. You don't buy a company and sell it 2 minutes later or 2 weeks later. You buy a company and you keep it for a length of time, maybe 10 years or 20 years or 30 years, for however long it is. But you don't just buy and sell a company in a few moments. And I think a lot of people new to the stock market, they have the mindset that they're going to buy a company, 2 months ago for $10 a share, for example, and now that particular company share dropped to $8 a share, and now they're running for the hills, thinking this is not the right time to be in the market. I've only lost $2. I'm going to take my losses and run. That is not the way you should be investing your money. There has always been corrections in the market, and there always will. Let me let you listen to some advice from my good buddy.
People, because they can make decisions every second in stocks, whereas they can't with farms, they think an investment in stocks is different than an investment in a business or an investment in a farm or investment in an apartment house. But it isn't. If you get your money's worth in terms of future earning power over the next 10 or 20 or 30 years, you're going to have made a good investment. And you can't pick them from day to day. If you can do that, you can, well, I haven't met anybody yet that knows how to do it.
In the time span that I've been trading in the market, I can think of about 3 or 4 different huge corrections that we had. I mean, statistically speaking, if you go back 100 years or so, even during the Great Depression, you had the stock market crash in 1929. I mean, the market just hit bottom for a good length of time. And you did start to see an increase, partially because of war, because war creates money. At the World War II, the Korean War, the Vietnam War, typically wars will create money, and you did see a pretty sharp decline in the 70s. Now you saw a gradual recovery over that time span, and then you had another correction, I want to say 1986 or 1987, which was the Black Monday crash, and correct me if I'm wrong, but I want to say 1987. This was still a little bit before my time, but with that correction, you started to see an improvement again until you had the dot-com correction in 99 or maybe early part of 2000. And this is when you saw some companies like, AOL, Pets.com, Navedweb, Global.com. You saw these companies just boom up and then just crash down, particularly Global.com. I want to say that when their company went IPO, they were initially asking $9 a share and actually sold during their IPO, I want to say $88, $89 per share. And within 2 years, Global.com dropped down to less than $1 per share. But the difference with the Global.com correction, normally corrections will happen over a period of time, whether it be days or weeks or maybe months. But with the dot-com correction, I think that happened within a matter of hours, or less than 1 day. So that's not really atypical of what happened during a correction. And then you skip forward another decade, and then you have, our good buddy George Bush Jr. in the housing crisis and the Lehman Brothers. Again, 07, 08, you saw another correction. Coming to where we are right now, you see another correction in the market that, if you ask me, should have probably happened quite a while ago. I think we've been kind of overvalued for quite some time. Even companies like Tesla or Amazon or either Square Inc. A lot of these companies have been quite overvalued for quite some time. And I saw a correction coming. Not that I'm a fortune teller or know what's going to happen, but you just look at the statistical charts of where we should be and where we are. You kind of get the feeling maybe we're going to have to kind of pull back a little bit. Now, how do you pull back? Do you pull all your money out of the market? No, I think this is when you start to do more defensive type investing. And what I mean by that is maybe some of those companies more speculative companies, as far as I'm concerned, is a lot. I take about 10% of my portfolio and kind of allocate it to the speculative companies. And when I say that, I mean companies I don't have a lot of confidence in, or just I'm not very sure about. So I have about 10% of my portfolio in blockchain technology. But then the other 90%, or not, I'm sorry, not 90%, then about 30% is companies I really, really have a lot of faith and I have a lot of confidence that they would do well in the future. And these are like fintech technologies like ARK Investments, anything to do with AI, robotics, any type of technology. I'll allocate about 30% to there. The other 50% I kind of keep in those bedrock companies that they will weather the storm. And some of those companies might be like Fortis, ticker FTS. Fortis, this is a great Canadian company. They're not going to have huge fluctuations. They're not going to gain a lot. They're not going to lose a lot. But these are pretty solid investments that they can normally ride out the storm. As a kicker, Fortis is paying a dividend of about maybe $1.90, $1.94 per share, at a dividend yield of about 3.9%. Epitome of stability, and it's a Canadian company to boot. This is a really kind of put your money, let it rain outside, don't care what's going on, and you're kind of maybe in a safe spot. Another one is BMO, Bank of Montreal, a great company, very stable. You're not going to see huge gains or losses, but it's a safe place to kind of park your money. Again, another dividend paying stock, Rockstar dividend paying stock, paying $4.24 per share at a dividend yield of about 4%. BMO, ticker BMO, I'm sorry, great company to maybe park your money into. And then the next one, actually I have about, I want to say 16 to 17% of my portfolio parked in Suncor Energy, ticker SU, another really great company. You won't see a huge jump in value, you won't see a huge decline in value, but very stable company. Again, this is a dividend paying fund of about $1.10 per share with a dividend yield of about 4.23. To kind of sum up everything, it is up to you to make your decision what to do with your hard-earned money. I'm just giving you my advice and what I would personally do. Okay? When you're dealing in the stock market, I really wish they would change the terminology of buy and selling stocks. I mean, yes, that's what it is, but you're actually investing in a company. And when you invest in company, you're investing in a marathon, not a race. If you like what you heard here today, do me a favor, hit that subscribe button, hit that like button, join the family, and let's grow our portfolio together. All right, guys, until next time, aloha.